Hey, welcome back. Despite the stock price recovering a bit, Verizon is still traded at a very attractive yield. As you're about to see in a bit, the company has been improving significantly in the past couple of years and there is still potential for a very nice recovery. At some point a few months ago, this was at half of the price from 2020, offering a yield of around 8.5%. After investing a lot in the C-band auction recently, Verizon has secured a very significant competitive advantage going forward. The cash flow is coming back to normal and we can already see a very significant improvement thanks to the lower CAPEX as expected. They made 18.7 billion last year, but with high CAPEX in Q1 related to the C-band auction. Without that, they would have made around 20.5 to 21 billion this year, placing them at a price to free cash flow ratio of around 8. This is a bit below the average of around 10. Now, when looking at the stock of companies like Verizon or at&t, keep in mind that it discounts the dividends. Not only that, but they also just went through a massive investing cycle that the market never likes during an environment with high interest rates with a lot of debt. Sure, they would be below the S&P, but it isn't that bad. They have 36.8 billion in current assets, which is not enough to cover the current liabilities, so they are going to have to rely on the cash flow and maybe some refinancing. But overall the total assets cover the liabilities by a huge amount, so it's not as bad as people think. Now, the debt is very high, but it's well covered by the assets and no year comes with a massive repayment. I'll say this again, if they had to pay all of it in half a decade, then yes, that would have been a massive issue, but some of the debt is due in 2030, 40, 50, 60, so it's a very different story. They pay a dividend of around 6.5 to 7%, which represents around 11.2 billion. Given the cash flow, this shouldn't be that big of a burden. They make around 20 billion in cash flows, so the payout ratio should be around 50 to 60%, and since the debt is very well spread, this should be very sustainable. Now, one thing I keep mentioning when it comes to dividend stocks is the way they react to interest rates. We can see Verizon, among many other dividend stocks, being up like 25–30% since October as a result of the Fed's interest rate decisions and good earnings reports. Why rate cuts are good for dividend stocks has to do with the opportunity cost. Even today you can get a 4–5% yield from the traditionally risk-free treasuries, so a lot of pension or other investment funds that would normally seek such a return park their money into that. There is simply no reason for them to risk it for a 1–2% premium when they can meet their target with basically no risk. However, when the rates get back to almost zero and these treasuries pay you close to nothing again, the market will have to increase the risk if they want a return that at least beats inflation. This can bring back the dividend yield of companies like Verizon to something like 3.5 to 4.5%, making this a potential 50 to even 100% profit depending on when you buy. On top of that, they give that very nice and sustainable dividend, so they basically pay me a very competitive yield just to wait. This is even more significant when you see that a majority of the company's stocks are held by institutions, and when the rates are cut, they'll have to migrate back into this kind of company. As a risk other than a recession, there is that lead cables issue. Now, the effect and how much, if anything, they'd have to pay is ultimately unknown, but even if they have to pay something like 15, 20 or even 30 billion, it wouldn't be that big of an issue. It would be bad, don't get me wrong, but it's unlikely to be something that would affect Verizon in the very long term. Another issue that's ultimately unpredictable is when and how much they'll have to invest in the future. This is a very CAPEX intensive industry, and we saw how much telecom companies invested in the C-band auction recently. If they enter into a new investing cycle in 2–3 years, they won't have enough time to pay back a significant amount of debt, which is bad in the long term. With companies already developing 6G, will they have to invest again in a decade or so? Or if there is a fine for the lead cables, that would also decrease the final cash flow for some time. And that, on the other hand, is something with a lot of potential. If they get 3, 4, 5 or more years, they can pay back a significant amount of debt. If they make 20 billion per year, 11 goes into the dividend and the rest can be used to pay back the debt, including some in advance. In half a decade, with zero growth and a slowly increasing dividend, they can pay 25–30% of the total debt. This then lowers the interest, increases the cash flow and accelerates the process, or at least guarantees a higher dividend. That by itself can add like 1.5 to 2 billion to the cash flow simply by not having to pay it as interest. As for a valuation, let's look into 3 scenarios. In a bad one, let's say that due to competition and overall a bad environment, they drop to 15 billion per year. If the market is trading them at a ratio of 10, that's a market cap of 150 billion, so very close to the current price. That would be around 35.7, so we've seen it even below this recently. Sure, they survive and stay afloat and you can see them as a dividend cash cow, but it's unlikely to see some growth. Now, they are pretty resilient to a recession, but the stock in all the market hysteria can still crash 30, 40, 50%, which would make it very attractive. In a second scenario, let's say they remain at 20 billion, which is actually below the current capacity. For a ratio of 10, which is pretty much average, that's a market cap of 200 billion for a price of around 47.59. That's a 20% profit plus the dividend. I think this scenario and the next one are more likely to happen given the current environment with soon-to-be falling interest rates. Now, in a good scenario, let's say they get to 25 billion as a result of a bit of growth, cost savings and debt repayments. For a ratio of only 12, that's a market cap of 300 billion for a price of 71.38. That would be an 80% profit plus the dividend, so if we get there in, let's say, 3 years, that's basically a 2x. I think this is reasonable and sure, there is more potential, but this is not the type of investment to grow 5x or something. This is a dividend cash cow that's currently below its fair value. Overall, I like Verizon and I think the current price is pretty attractive. The debt is very high but manageable and covered by the assets, the business is very profitable and already recovering from the investment cycle, and the dividend is very attractive. I think that once the Fed cuts the rates, this can be a relatively quick 50 to 100% profit or even more, plus locking in that very nice dividend. Is it cheaper than AT&T? No, but I don't think they are currently too far, and to be fair, I like and I own stocks in both of them. I was able to buy quite a bit of both when they were paying close to 8% a few months ago, but even the current price is not bad at all for me. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.